Big news out of Washington. The US is considering slapping 25% tariffs on imports, and if you think that won't shake up the stock market, think again. Because when tariffs go up, supply chains get tangled, inflation flares up, and investors, well, they start scrambling. So, what's the deal? The US is looking at broad-based tariffs, including on goods from Canada and Mexico. If this happens, it's game on for retaliatory tariffs from trading partners, think Canada, the EU, China. And when countries start taxing each other's goods, costs go up, profits get squeezed, and global trade slows down.
And guess what?
That's a big red flag for stock markets.
Let's break it down.
Tariffs are basically taxes on imports, and companies importing goods now have two choices: eat the cost or pass it to consumers. Either way, it's not pretty. Businesses taking the hit could see shrinking margins, which means weaker earnings. And we all know what happens when earnings drop, stock prices follow. On the flip side, if they pass the cost to consumers, you and I are paying more at the checkout, which fuels inflation. More inflation? That means central banks might keep interest rates higher for longer, making borrowing more expensive and stocks less attractive. Now, let's talk about industries. Some sectors are more vulnerable than others. Auto manufacturers? They're in trouble. Car parts cross the Canada-US border multiple times before a vehicle even rolls off the lot. Every crossing means another tariff charge. That's like paying shipping fees every time you move a package between rooms in your house. Higher production costs mean higher car prices, which means fewer sales. That's bad news for stocks like Ford, GM, and Stellantis. Retail? Same story. Companies like Walmart, Target, and Costco rely on cheap imports. Tariffs make those imports pricier, cutting into profits and pushing up prices for consumers. Investors holding retail stocks? Brace yourselves. Commodities, though? This gets interesting. Lower trade volumes could hit global demand, which means lower oil prices. That's bad news for energy stocks like ExxonMobil and Canadian Natural Resources. But on the flip side, if tariffs spark inflation concerns, investors could pile into gold as a hedge. So watch out for moves in gold miners like Barrick Gold and Newmont. And here's a wild card: currencies. If tariffs go through, the US dollar might strengthen as global investors see it as a safe haven. But for Canada, the loonie could take a hit. A weaker Canadian dollar makes exports cheaper, but with tariffs blocking trade, that advantage could be wiped out. So what should investors do? First, watch for volatility. Markets hate uncertainty. Second, keep an eye on sectors that thrive in inflationary environments. Think consumer staples and utilities, which tend to hold up when costs rise. And third, consider hedging with gold or other defensive assets. Bottom line: tariffs aren't just trade policy, they're stock market landmines. Stay informed, stay nimble, and as always, trade smart.
What do you think?
Are these tariffs a short-term scare or a long-term market disruptor? Let's discuss in the comments. And if you found this breakdown helpful, hit that like button and subscribe for more deep dives. This is Legacy Analysis, helping you navigate the markets one trade at a time.
See you in the next one.